Gold defends its bid tone near the $4,700 mark in the European session on Monday, lacking bullish follow-through buying. Reports suggest that Iran gave the U.S. a new proposal on reopening the Strait of Hormuz and ending the war, with nuclear negotiations postponed for a later stage. This revives hopes for U.S.-Iran peace talks and undermines the U.S. dollar's reserve currency status, which is seen as acting as a tailwind for the commodity. From a technical perspective, the precious metal has been consolidating in a familiar range since the beginning of this month. This comes on top of a solid rebound from the very important 200-day simple moving average (SMA) tested in March and suggests the broader uptrend remains intact, even as momentum cools. In fact, the Relative Strength Index (RSI) is hovering near a neutral 47, and the Moving Average Convergence Divergence (MACD) indicator is showing only modest positive readings. This hints at waning upside pressure rather than a decisive reversal, suggesting a period of sideways to soft consolidation before a clearer directional move emerges. Meanwhile, weakness back below the $4,700 mark might continue to find decent support and attract fresh buyers near the lower boundary of the month-to-date range, around the $4,650 to $4,645 region. A convincing break below might prompt aggressive technical selling and pave the way for deeper losses. On the upside, the $4,750 area could act as an immediate hurdle ahead of the $4,800 mark and the $4,860 to $4,865 region. The latter represents the top end of the trading range, which, if cleared decisively, will be seen as a fresh trigger for bullish traders and set the stage for a further appreciating move beyond the $5,000 psychological mark. Fundamental overview. The optimism exerts some downward pressure on crude oil prices and eases inflationary concerns, leaving the door open for at least 125 basis point (BPS) interest rate cut by the U.S. Federal Reserve (Fed) in 2026. This turns out to be another factor weighing on the greenback and benefiting the non-yielding gold. However, a combination of factors might hold back traders from placing aggressive bullish bets on the XAU-USD pair and keep a lid on any meaningful appreciating move. Traffic through the Strait of Hormuz remains largely blocked due to Iran's restrictions on movement and the U.S. naval blockade of Iranian ports. Furthermore, Israeli Prime Minister Benjamin Netanyahu said he has ordered the military to vigorously attack Hezbollah targets in Lebanon. This keeps geopolitical risks in play, which should limit losses for crude oil prices and the safe haven USD, warranting some caution before positioning for any further move up for the XAU-USD pair. Traders also seem reluctant and opt to move to the sidelines ahead of the crucial two-day FOMC policy meeting, starting on Tuesday. Investors will look for more cues about the Fed's policy path amid still sticky inflation and resilient U.S. economic activity. The outlook, in turn, will play a key role in driving the USD demand. Apart from this, developments surrounding the U.S.-Iran saga should contribute to infusing volatility and providing some meaningful impetus to the XAU-USD pair. Meanwhile, gold premiums in India climbed to their highest in over 2.5 months last week due to limited supplies. Moreover, bullion traded at premiums of $9 to $12 an ounce in China, up from the previous week's premium of $3 to $6 amid some renewed physical demand and fresh buying interest, further favoring bulls. This, in turn, backs the case for a further upside for the XAU-USD pair and suggests that intraday slides are more likely to be bought into and remain limited.